Okay, we're going to talk about complete liquidations, and then we're going to talk about asset acquisitions, but it's not really just asset acquisitions. I'll probably have to break this into a couple pieces. I don't know, maybe I'm trying to prevent you from getting bored. Okay, so let's go back through our kind of where we stand on everything. Creating a corporation, operating a corporation, distributions. We've now talked about transfers of ownership. Now we're into complete liquidations, which is like the reverse of contributions. And then we'll talk about reorgs. So I want to follow up with a couple redemption items that I don't think we covered was it 2 weeks ago? Nah, it was last week, whatever. Which is sale and dividend treatment. So we covered substantially disproportionate redemption. We covered complete termination of interest. We covered partial liquidation. We covered not essentially equivalent to a dividend. And now we're going to talk about liquidations for a non-corporate shareholder and a corporate shareholder. So that we're calling that out in advance so that we understand that those are treated differently. All right, a couple follow-ups on partial liquidation. So a distribution is treated as not essentially equivalent to a dividend if it's attributable to the distributing corp ceasing to conduct or consist of the assets of a qualified trade or business, right? So that's, that partial liquidation. Immediately after the distribution, it's actively engaged in the conduct of a qualified trade or business. So this implies that there is some continuing activity that goes on. And it distributes all the assets or all the proceeds from the sale of the assets of the terminated part of the business. We said really those were squishy rules. Qualified trade or business means any business that was actively conducted through the 5-year period on the end of the date of the redemption and wasn't acquired in a taxable or partially taxable transaction in which gain or loss was recognized in that 5-year period. So that's all repeat, nothing new here. In the case of a distribution of the assets of the business in kind, the terminated business is operated by the distributing corporation until the date of the distribution. So that's, the idea is if you're distributing the assets themselves, right? You're not selling them and distributing the property. And in the case of a distribution of the proceeds from the sale of the assets, the business is operated until the date of the sale, and the proceeds are distributed as soon as reasonably possible after the sale. Okay, so we said, what does it mean to be not essentially equivalent to a dividend? And we said the rules were squishy. So let me talk about what we do have. So there's a Supreme Court case, U.S. versus Davis. It had 4 rules. It said the constructive ownership rules apply. So these rules about attributing stock ownership to family members and related parties apply. Redemptions from a sole shareholder are always fatal under the Davis ruling. So that means if you're 100% owner, it doesn't matter how hard you try to do a redemption, it's never going to work. The business purpose is irrelevant in a redemption. So it's not as if you can claim some sort of business purpose to get you there. And it must result in a meaningful reduction of the shareholder's proportionate interest. So sole shareholder or pro rata for all shareholders is essentially equivalent. So the idea is obviously the sole shareholder, or like we talked about under the debt versus equity rules. If all the shareholders are treated the same, everyone shrinks by the same amount, then it's the same situation. So there was an appellate court decision, Himmel versus Commissioner, that came out. And it said that 3 potential interests must be reduced in order to have not essentially equivalent to a dividend treatment. There must be a reduction in the voting rights or voting control. There must be a reduction in the interest in earnings through dividends or the interest in assets through liquidation. And the IRS rejected Himmel. It said, no, it must include a voting rights reduction. So it can't be the other 2 only. So meaningful reduction is left to courts to decide in states where a supermajority shareholder vote is required for the approval of major corporate acts. Redemption below a supermajority has been held not essentially equivalent to a dividend. But of course, the IRS wants less than 50% after the redemption. So there are problems when you start below 50% because the idea that there's a loss of concerted control now is a dubious proposition. Because if you only own 49, then dropping to 48, well, you are below 50%, but whether there was a loss of concerted control is difficult to derive. And in public company redemptions, we usually call these a tender offer. So a public company makes a tender offer to its shareholders to buy back a certain amount. These generally involve minuscule reductions in voting rights, but almost exclusively, we did discuss this last week, almost exclusively get not essentially equivalent to a dividend, and therefore redemption or sale treatment. Okay, now the new stuff, corporate liquidations. So corporations winds up its affairs, it pays all its debts, and distributes the remaining assets to its shareholders. That is in fact, the pragmatic corporate liquidation. As a tax concept, it's the termination of corporate activities, the satisfaction of liabilities, and the distribution of the corporation's assets. And this produces sale or exchange treatment to the shareholder. So notice that there's no essentially equivalent treatment here, right? If there is a complete corporate liquidation, the shareholders get sale or exchange treatment. That means they get to recover their basis. The liquidating corporation is going to recognize gains and losses upon distributions of its assets. Now, there are certain exceptions, but this is a big difference between most of the other forms of getting your money out of the corporation we've talked about, in that losses were rarely, if ever, permitted. In this case, there are. But there is a giant fat exception to these rules, and this is a 332 liquidation of a subsidiary corporation. So in the case of the liquidation of a corporate subsidiary, so a corporation's the owner, not individuals, the rules are entirely different. So we need to bear that in mind. You'll recall at the top of the video, I said, hey, there's a big difference between corporate shareholders and non-corporate shareholders. Yeah, it's huge. Okay, so the structure of part 2 of subchapter C is all about liquidation. So subpart A, what are the effects on recipients? That comes in 331, 32, and 34. Subpart B is the effects on the liquidating corp. That comes through 336, 37, and 38. There is no subpart C currently. And subpart D has the definition of what a complete liquidation is. So let's assume that a closely held corporation is going to be liquidated. And the corporation owns a mixed bag of appreciated and depreciated assets. So that's some are above basis, some are below basis. But in total, the aggregate fair market value is $2 million. The aggregate adjusted basis is $500,000. So in aggregate, most of the assets are appreciated. So the shareholders have aggregate adjusted basis in their stock in this corporation of $200,000. So the corporation's done well, probably been around for a while, maybe. Managed to drive up the value of itself. But the founder's stock is not worth very much, only $200,000. So a complete liquidation will generate a net gain of $1.5 million for the corporation. Of course, if all these gains and losses on the various items can be offset against each other, and there's some likelihood that that would be the case. The shareholders compute their gain or loss under 331A by subtracting the basis of their shares from the net fair market value of their respective portions of the liquidating distribution, which amount reflects the corporation's own tax liability. So, let me give you an example. Assume the corporate tax liability of $500,000. The aggregate amount distributed to shareholders will be $1.5 million. So remember, they're going to sell everything for $2 million. Now, there's a gain of 1.5, but the reality is they'll get cash of $2 million. However, if we assume a corporate liability of 500,000, and I probably should have chosen a different number so that it wasn't equal to the basis to make it less confusing. In any event, they will get 1.5 million. If all shareholders realize gains, their aggregate taxable gain will be 1.3 million. That's the 1.5 they're receiving, less the adjusted stock basis of $200,000. Thus, a complete liquidation produces the exact same result at both the corporate and shareholder levels as if the corporation had sold all of its assets to third parties and distributed the proceeds, less its tax liability to shareholders. So basically, it doesn't matter if the corporation sells all the assets inside itself or distributes those assets out to the shareholders. Because what we're going to find is that the corporation has to treat the distribution in complete liquidation as a deemed sale of all its assets to its shareholders, to the extent it doesn't sell them to a third party anyway. Okay, so for non-corporate shareholders, except as otherwise provided in this section, the gain or loss shall be recognized to a liquidating corporation on the distribution of property in complete liquidation as if such property were sold to the distributee at its fair market value, which is precisely what I just said. The gain and loss is calculated separately on each property, so you don't get to just aggregate them, but in large part, there's some chance that you would get to aggregate them anyway. Depends on the netting situation the corporation is in. The character of the gain or loss is the same as the character of the property in the hands of the corporation. Debt will not affect the gain-loss calculation unless the debt exceeds the fair market value of the property. If debt is greater than fair market value, then the fair market value is deemed to be the debt. If the debt is not associated with a specific property, then you allocate the debt to the properties based on their fair market values. And any gain or loss recognized by the corporation will, of course, affect the liquidating corporation's earnings and profits. Losses distributed to a related party are disallowed. Okay, so remember, we said losses are permitted, but they are disallowed to a related party if, one, the distribution is not pro rata, and we're going to have to explain what that means because it's not exactly what you think, and where the property is acquired by the corporation within 5 years of a distribution. This is called the anti-stuffing rule, which is basically, it relates back to a time when you could pop loss property into a corporation in a 351. As you know, you can't any longer, but that makes the anti-stuffing rules. So losses with tax avoidance purpose. So these are losses that accrue after the contribution of lost property to the corporation are allowed to the corp on distributions. So the lost property contributed in a 351 if contributed within 2 years before the adoption liquidation plan. The presumption is that was done for tax avoidance. Okay. Sorry about that. Got a phone call. Maybe you heard my phone. Okay, so tax avoidance motive. Anything contributed within 2 years through a 351 is going to be considered tax avoidance unless you can really work hard to overcome that. This is really much less important since the contribution of lost property requires a step down in basis anyway. So not that big of a deal. Okay, so this pro rata rule, remember it said that loss distributed to a related party is disallowed if the distribution is not pro rata. So let's talk about what it means, because what it doesn't mean is that it's distributed consistent with the ownership percentage. Because the reality is it has to be distributed consistent with the ownership percentage, or you got something completely different going on. And most states' corporate law requires that it be distributed with your ownership percentage. So let's say X Corp stock is owned 80% by A and 20% by S. And they're both individuals here. So we're not talking about a corporate liquidation. And when we look at X Corp's ending balance sheet, we've got cash, which is $600,000, which is equal to its fair market value. We've got equipment with a basis of $150 and a market value of $200. And we've got a building with a basis of $400,000, but a fair market value of only $200,000. So the building's gone down in value. Well, a building cannot be distributed easily 80-20, right? So think of that. Like I can't give 20% of the building to S and 80% of the building to A. Now, technically you probably could, but not easily. So instead, what you might do is say, well, let's give A the cash in the building, right? Because the fair market value of the cash in the building is 80%, and S gets the equipment. The problem is A is a related party, and therefore the loss of the 200,000 on the distribution cannot be recognized, because remember, that distribution is not pro rata. We're not taking the pro rata share of each of these items, the cash, the equipment, and the building, and splitting it up 80-20. Instead, we took different components and delivered them to the shareholders. So one easy way around it in this instance would simply be distribute the lost property to S. Because since S is not a related party, remember they only own 20%, they can go ahead and recognize the loss. Because remember, the loss distributed to related parties disallowed if the distribution is not pro rata, but in this case, they're not a related party. Okay, what about to the shareholder? That's the corporation's treatment. What about the treatment to the corporation? Well, the amounts received by shareholder in the distribution in complete liquidation shall be treated as in full payment in exchange for the stock, which means you get sale treatment, right? So think of this as redemption in its ultimate form. The amount realized is the fair market value of the property received. The basis is used to calculate gain as the shareholder's basis in the stock. So A owns 100 shares of Humdrum purchased for $10,000. Humdrum has 12,000 of accumulated E&P, and then Humdrum distributes 20,000 to A in exchange for A stock in a complete liquidation. The result is going to be a $10,000 long-term gain, right? That's the 20,000 received less the $10,000 basis. And note that E&P is not even relevant in a complete liquidation, right? So we don't have to worry about whether there's any E&P. So to the extent there is any E&P, it's gone. None of it is treated as dividend. Gain would be calculated on a block-by-block basis, not on an aggregate basis. So that means if the shareholder acquired, so if A bought 100 shares of Humdrum at different times, so that could mean it could be short-term or long-term, it could have completely different basis. You have to do that calculation on a block-by-block basis. This is generally considered better than dividend treatment, right? Because, of course, we got the cash out of the corporation, we also offset it with all of our basis. Okay, so remember, since 332 takes care of corporate owners, we don't even need to worry about whether a corporation will get a dividends received deduction, which would make dividend treatment fine for them. But what we're going to see is a corporate liquidation of a subsidiary gets completely different treatment. So shareholder S holds 60 shares of X Corp, long-term with a 30,000 basis, and 40 shares short-term with a 50,000 basis. So they own 100 shares. Their basis is 30,000 in one block and 50,000 in the other block. And they were bought at different times. So one's long-term and one's short-term. So if S gets $100,000 in a complete liquidation, you would have to bifurcate the amount realized, allocated using the fair market value of the underlying stock. So we've got, 60 shares and 40 shares. So we would allocate that based on the $100,000, right? Because that each share is assumed worth an equal amount. So 60% of the amount realized goes to the long-term shares, the 60 shares. 40% goes to the short-term shares. The adjusted basis in each is whatever they are. And so you get one with a long-term gain and you actually have one with a short-term capital loss. And that just shows that the liquidation is done on a block-by-block basis. If multiple cash transfers are liquidating distributions, right? So it happens with multiple payments out. Then Rev Ruling 85-48 permits full recovery of basis before reporting any gain, which is awesome, right? So that means you recover all your basis with the initial payments, and then you would start to recognize gain. Now, what we're going to see is that the rules require us to do these distributions in a fairly short amount of time, and so it's not like we get a big, fat, long deferral. The offset to that is that if you are distributing in a complete liquidation And from a shareholder's perspective, it would be a loss. You don't get to recognize any of that loss until that last distribution is received. Shareholder S holds 60 shares of X Corp, 40 shares short-term with a $50,000 basis. So again, this is the exact same example. If S first received $70,000 in the first liquidating distribution, and then $30,000 in the second, you would calculate the gain or loss based on the amount realized that you allocate using fair market value. So initially, when that $70,000 is distributed, you'd say, okay, well, 60% of that, right, 60 out of the 100 shares, goes towards the long-term shares, and then the other 40% of that 70,000 goes towards the short-term. So you got the 42 and the 28. The adjusted basis in each is 30 and 50. And so what would happen is you can see that we have to recognize gain for the 60 of long-term shares. But notice that we have basis remaining for the short-term shares. As a result, no loss is recognized. We just accumulate the charge against our basis. Then in the second distribution, we would allocate again 60-40 of that 30,000, 60,000 going to the 60 shares, the long-term shares. Well, since we've already used up all of the basis, there's none left to use, so all of that drops right into a long-term capital gain. With respect to the short-term shares, we haven't used all the basis, and so now the amount realized less the adjusted basis creates that $10,000 long-term, in this case, short-term capital loss. Okay, gosh, now I don't remember where I left off, so I hope to finish this one. All right, more treatment to the shareholder. Under 334A, tax-based shareholder for any property received is its fair market value at the time of the liquidation distribution. And recall that is exactly like a non-liquidating distribution of property. If the shareholder assumed liabilities, the amount realized is fair market value less liabilities, because remember in this case, it's not the amount of the dividend, right? Because it's the amount realized that were reflected, so we will lower it, but we do lower by liabilities, just like we did the dividend. But the basis in that property remains the fair market value, right? You do not reduce the basis by the liabilities that are assumed. Shareholder S, 100 shares of X Corp, $330,000 basis, receives property with a market value of 70, subject to a liability of 20. In a complete liquidation, the amount realized is 50, the adjusted basis in the shares is 30, so we got a capital gain of 20,000. And S's basis in that property would be 70,000. And of course, the liability must be legit, meaning the shareholder is expected to pay that liability. All right, are there any special issues with debt? Of course there are. If it's contingent debt, right? If it's subject to some sort of contingency, then you do not get to treat that as debt. So shareholder S, 100 shares of X Corp, 30 basis, gets property of 70,000 subject to a contingent liability. Then you can see that that liability is not recognized, right? The amount realized is the full 70,000, resulting in a $40,000 gain because the liability is simply ignored. If at some point in the future S pays the liability, then they would treat that as a capital loss. They're also, if the return is eligible, they can open up the old return and amend it if they want to. All right. Yeah, that's enough for that area. If the shareholder holds the debt of the corporation, so S is a shareholder in X, and X has debt to S of $100,000 at the time of liquidation. In this case, the distributions in complete liquidation will need to be bifurcated. So the amounts unpaid for outstanding indebtedness are applied first. Then you get sale treatment on the shares themselves. If the debts are not repaid and no additional distribution is made, then it's not a liquidation. It's simply worthless stock, right? Because there's not enough money to pay off the debts that they owe you first. So clearly your stock is simply worthless. There are some timing issues to the extent an installment obligation is distributed. It says that you're going to get a rateable tax basis recovery even when the selling price is not readily ascertainable. This is a creeping liquidation, distribution, and cost recovery. So we have to classify these under two areas. One is an open transaction where the value of the proceeds is not readily ascertainable, and that is considered a rare circumstance, versus a closed transaction where the value is ascertainable. So S is a shareholder of X, basis in shares is 30,000. X liquidates, expected to receive 2 payments over time. If you can ascertain the value of both of those is 25,000, then you would treat it as a closed transaction. So of course you get 50,000, the basis is 30, you got a realized gain of 20,000. Your gross profit percentage, just like it would be under the installment method, is 40%. So each time you receive a payment, you would recognize a gain relative to your gross profit. So 40% of the first 25,000 is $10,000. Then when you get the second payment of 25,000, another 40% or $10,000 is recognized. If it's open, notice what happens. The first payment is total return of basis, right? So it's an ordering issue. Obviously, you'd almost always rather get all your basis back first because then there's no gain. And then that second payment comes along and you recognize the rest of it. And that's because you were unable to ascertain the value of the proceeds at the time of the deal. Multiple cash transfers are liquidating distributions, then the full recovery of tax before they report any gain. We already covered that in a previous, but the installment sale provides for rateable tax basis recovery even when the selling price is not readily ascertainable. So this is a sticky issue, and what you can expect is if you're claiming gain, you can expect there to be a lot of pressure to value the contingent payments from the IRS. And if you end up with a loss, they're going to be less concerned, right? Because now they get to wait until the end anyway. If the liquidating corporation sells its assets to a third party in an installment sale, and that installment note is actually what's distributed to the shareholders, that's different. The installment sale treatment is available. It must be part of the liquidation plan, and it's not available if the stock was publicly traded. So the holding period for property distributed does not tack on. So the shareholder, if they get property in the complete liquidation, the holding period for that property begins at the date they receive it. And note that there's no dividend treatment. Basically, E&P never matters. All right, let's take a break right there.